Welcome, traders and dreamers. I'm Arcadius, the force behind indomitable solutions. Get ready to supercharge your Forex prowess in episode 3. We are uncovering 4 game-changing agendas today. But hey, this is just a test. Our 10-episode series is your path to trading supremacy. So, buckle up. Episode 3 is your gateway to greatness. Let's dive in and sculpt your trading destiny. Today, we are covering 4 agendas. Agenda number 1, how to read Forex charts. Agenda number 2, 10 Forex trading tips from experts. Agenda number 3, understanding leverage in Forex trading. And the final agenda is factors that influence the Forex market. How to read Forex charts. There are 3 types of charts in Forex trading. That is, line chart, bar chart, and candlestick chart. We shall begin with the line chart. This is the most basic type of chart in Forex trading. It connects closing prices with a line. It doesn't show opening, high, or low prices. It provides an overview of price changes over time. And lastly, it is useful for tracking closing prices accurately. Let's now look at the bar chart. It displays more detailed information than a line chart. It includes the opening, high, low, and closing prices. It is composed of a left dash, opening, and a right dash, closing. A vertical bar represents the trading range, that is, high to low. It is also known as the open, high, low, close chart. That is OHLC chart. Finally, let's consider the candlestick chart. This is the most popular chart type in Forex trading. It presents price info in a placing format. It focuses on opening and closing prices. It displays opening, high, low, and closing prices using candlesticks. Finally, candlesticks height show the high-low range. Width show opening, closing differences. Up to that point, we have covered 3 types of charts. That is the line, bar, and candlestick chart. Remember this, the line chart is the most basic and it only shows the closing prices. On the other hand, the bar chart provides more details, that is the open, high, low, and close values. The candlestick chart, on the other hand, it is the most popular, aesthetic, and it shows the opening and closing focus in trading. These chart types help traders analyze price movements and make informed decisions in Forex trading. Therefore, you should know them. Let us now dive into the second agenda. That is 10 Forex trading tips from experts. Tip number 1, start gradually. Begin with small amounts of money. Slowly build your investment portfolio. Limit the number of positions to manage effectively. And finally, avoid rushing into multiple trades at once. The second tip is use stop-loss orders. This is essential for managing risk. Always set a stop-loss order to limit potential losses. This will protect your capital in case of unexpected rate changes. The third tip is always apply the 1/6 rule. Don't get caught up in excessive trading. Risk no more than 1/6 of your free trading capital. This is especially important when you lack complete confidence. The fourth tip, always stick to your strategy. Create a trading plan and stick to it. Document your trades and strategy decisions. Analyze your plan for improvement over time. The fifth tip, don't stop profits prematurely. Avoid letting greed dictate your decisions. allow winning trades to fully develop, and capture the full profit potential of your positions. Hope the first 5 are clear. Tip number 6, follow the trends. Trends indicate market direction. Avoid trading against the trend. Analyze trends and position yourself accordingly. Tip number 7, study Forex charts. There are different tracking systems and charts in each market. Analyze multiple time frames before trading. That could be daily, hourly, and weekly charts to offer you insights in form of trading. The 8th tip, trends have momentum. Identify and capitalize on emerging trends. Act quickly as more traders join a trend. Align your trades with strong market momentum. The 9th tip, review past trades. Continuously analyze your trading history. Learn from successes and mistakes, and adapt strategies based on past performance. And the final tip is close and successful positions. Avoid holding losing trades for too long. Cut losses early to free up capital. Focus on more promising trading opportunities. Remember, success in Forex trading requires patience, discipline, and continuous learning. Following these tips will help you build a solid foundation for your trading journey. Let us now dive into understanding leverage in Forex trading. Leverage is a concept in Forex trading that allows you to trade with borrowed capital. This increases your potential profits, but also your potential losses. This is how it works. By definition, leverage involves using borrowed funds from a broker to enter trading positions. It is like a loan that amplifies your trading power. So, how do the leverage ratios work? I've given you 2 examples. The first example is with a leverage of 1 to 20, you can invest $100 and trade with $2,000. The second example is with a leverage of 1 to 200, you can invest the same $100 and trade up to $20,000. Hope that is clear on definition and leverage ratios. Let us proceed. Let us now consider profit calculation in regard to leveraging. I've given you 2 examples, example A and example B. In example A, with a pip value change of plus 0.0030, it leads to a profit of $6. This will result in an account balance of $106. That means the return on investment is 6%. On example B, with a $60 profit, it makes the account balance to be $160. That means the return on investment is 60%. I think you've seen the difference. How using leverage A above, that is the ratio of 1 to 20, gives you a profit of $6 and with a return investment of 6%. While using example B, that is a leverage of 1 to 200, it gives you a profit of $60 and the return on investment is 60%. Hope that is clear. So note this, the higher the leverage, the higher the return on investment. A higher leverage ratio increases your potential returns, but it also magnifies your potential losses. Hope that is also clear. In case you've got any question, feel free to comment and I'll respond to it. Let us now consider tips and warnings in regard to leveraging in Forex trading market. I'll share with you 4 vital tips and warnings in that regard. Tip number 1, always manage losses. Avoid risking all funds in one trade. Also, it is important to spread risk by limiting exposure to about 5% of your total deposit per trade. The second tip is always use stop loss orders. It is important to set stop loss orders to sell a currency if it reaches a specific price. Also, these will protect positions when you are not actively trading. The third tip is always employ strategic stops. Strategic stops limit losses and protects profits. Also, it helps you manage risk during volatile market movements. And finally, always start slow. Begin with a lower leverage to gain experience and confidence. As you learn more, you can consider increasing leverage. Remember, while leverage can boost profit, it also increases risk. Always trade responsibly and stay informed about market trends and strategies. Let us now dive into the final agenda for today, that is on factors that influence the Forex market. The Forex market is driven by various factors that determine the movement of currency pairs. Understanding these factors can help you identify trading opportunities and make informed decisions. These drivers fall into 4 main categories. I'll be sharing with you each category and an explanation. The first category is politics. Politics is affected in 3 different ways. That is, through public statements, change of officials, and stability of governments. In regard to public statements, comments from political leaders and policymakers can impact currency values. In regard to change of officials, transitions in government leadership can lead to market uncertainty. And in regard to stability of governments, currencies are affected by the political stability of a country. Let us move to the second factor, that is economics. Also under economics, it is divided into 3 different ways. That is GDP, inflation and debt, sales amounts, and interest from investors. In regard to GDP, inflation and debt, key economic indicators like gross domestic product, that is GDP, inflation rates, and national debt influences currency strength. In regard to sales amounts, consumer spending and business sales can affect currency demand. And finally, in regard to interest from investors, currency values respond to the interest of foreign investors in a country's market. Let us now proceed to factor number 3, that is central banks. Under central banks, we are looking at 3 factors, that is finance circulation, interest rates, and mandatory reserve funds. Under finance circulation, the amount of money in circulation affects currency supply and demand. On interest rates, central banks' decision on interest rates impacts currency values. And on mandatory reserve funds, regulations regarding reserve funds held by banks influence currency's liquidity. Let's proceed to factor number 4 on natural disasters. This includes hurricanes, earthquakes, floods, among other natural disasters. Natural disasters disrupt economies and impact currency stability. Therefore, by staying informed about these factors and regularly checking news updates and economic calendars, you can perform analysis to gauge potential market movements. Remember that all fundamentals indicate where investors are likely to allocate their funds and which currencies will be affected as a result. And finally, let us consider 6 biggest Forex market movers. We shall start with inflation. Inflation rate reflects the general price level of goods and services. High inflation reduces currency value compared to others. Lower inflation, on the other hand, enhances purchasing power. Always trade lower inflation currency against higher inflation currency. The key indicator in this case is Consumer Price Index, that is CPI. Higher inflation hampers investment, while low and stable inflation encourages investment. Let's proceed to the second market mover, that is employment. Employment impacts economic activity and exchange rates. More employed people increases economic output. High employment rate boosts currency, low rate depreciates or depresses currency. Unemployment rate influences currency negatively. The key indicator in this case is US non-farm payroll figures. Other indicators are unemployment rate, participation rate, and labor statistics. Let us now consider the third market mover, and that is trade balance. Trade balance affects currency values via exports and imports. More exports strengthen currency. More imports weaken currency. Trade surplus is equals to strong demand for goods and currency, while trade deficit is equals to weaker demand for goods and currency. A better trade balance is positive for currency, while worse trade balance is negative for currency. Let us now look at the fourth market mover, that is quantitative easing, that is QE. QE expands central bank's balance sheet and money supply. It is linked to inflation as money supply affects purchasing power. QE is used by central banks like the USA, Eurozone, Japan, and UK. QE timing influences Forex market trends. Trade based on QE policies always, that is, selling during winding down. And finally, watch for signals of further QE for potential trades in the market. Let us now look at the fifth market mover, that is country politics. Political changes impact economy and currency. Protectionist measures and policy shifts affect currency. A revolution or a coup can lead to currency instability. Currency value is tied up to public perception of economic safety. Political stability is crucial for economic growth in any country. Always consider long-term plans and political shifts in trading decisions. And finally, let us look at the final market mover, that is interest rates. Interest rates influence borrowing, saving, and consumption. Higher rates encourage saving and investment. Lower rates encourage borrowing and consumption. Interest rate differential affects currency flow. Changes in interest rates are high impact events. Trade on central banks' announcements about rate changes. Therefore, by understanding these 6 market movers, you can navigate the Forex market with the more insight and make informed trading decisions. Master the art of Forex trading with confidence. From decoding charts to expert tips, you're on the path to success. Reach out at 0721 290 925 or indomitablewriters@gmail.com to fuel your trading journey. Happy trading. It has been the Indomitable Tech series, and until next time, adios.